Good evening, everybody. Good afternoon, possibly good morning for you. Sound check. Hi, everyone. Welcome to tonight's DTS special event, the three parts of every strategy. If you're newer to DTS, welcome. My name is Paul Lange. I am DTS, Discipline Trading Strategies company. I started 3 years ago. After doing this for a long time, went off on my own. Have been enjoying every minute of it and having fun doing this. Tonight needs a little preemptive explanation just for a little bit. First of all, to the seminar program students who are here, I apologize. This will be a watered down rerun of what we did last week. But when I did that last week, I thought that this would be an appropriate general discussion topic for everybody. I used to use the language I'm going to use tonight a lot, and I haven't used it that much at DTS. I typically use it when I'm in a group like this, in a workshop type of group, to explain some great concepts to get you going or help organize your thoughts if you're learning to trade or invest on your own. And for the seminar students, I had to take a minute to explain, to say, look, this is nothing new I'm teaching you tonight. Now, kids can stay here at the moment. I'll give you a warning if they need to leave. When I talked to the seminar students, I had to kind of explain to them, this is not something new. Don't be confused. You're learning nothing new tonight. But it's a different way to put your arms around it, a different way to structure it, a different way to think about it. And I've always liked this way of phrasing it, and I got probably kind of a record number of compliments. When I say that the seminar group, the seminar programmers, besides the seminars, we get together in between seminars a couple of times and do additional topics. They're called practical application and review days. And we do various things. In this last one, I did this exact title, Three Parts of Every Strategy. Actually, I called it Any Strategy. I noticed I changed that by accident, not by any purpose. So it's called the Three Parts of Every Strategy. And I think everybody really enjoyed it. And naturally, it's going to be with a slightly different flavor as I present it to you, because the group that I presented it to, the seminar students, they're all been trained, at various levels in technical analysis by me. And it was a different way to regroup their thoughts. For a lot of you, this may be more knowing the appropriate questions to ask, and I'm going to give you what answers I can, but obviously some of the answers tonight involve, the whole in-depth knowledge of technical analysis to really get to the final answer. I'm not sure if that makes sense or not, but as we go through, maybe it will. Three parts of every strategy. The top paragraph I'll deal with in the next couple of slides here real quick. But the bottom two I wanted to re-emphasize to you, even though they were in the email and you may or may not have read them. Sometimes even having the right knowledge will not make you successful if you don't have the right structure. In other words, you have to know how to use the knowledge properly. Does that make sense or ring a bell with you guys in general? Just in general out there? In other words, do you know of people who have knowledge but aren't successful with it because they don't really know what to do with it? Common thing, you know that? A lot of people you work with, have met, went to school with, whatever. Yeah, I think it's almost a platitude. It's almost a very common thing. And it can be a real problem. I think it's an especially true thing in trading. A lot of people gain all this knowledge in terms of just this checklist, if you will, this laundry list of crap that they learn, just whether it be different technical indicator names or this or that, and they have this whole list of stuff, and it's all there, and it all makes sense in a vacuum, but you put it together and they just have a mess on their hands. This will help you a great deal to try and understand, in what is almost going to end up being ridiculously simplistic terms, what we're trying to do. And when you realize what we're trying to do, it really simplifies the process a lot and makes you realize sometimes that maybe some of the things you're focusing on are not really helping you at all. The discussion will focus on this is my red ball. Can't go without my red ball here. The discussion will focus on these three broad concepts with chart examples showing the key things that need to be understood, and will likely point to many reasons the traders come up short of succeeding. Now, tonight is not, when I say the three parts of every strategy, I know there's a lot of talks I do and they make it confusing because the number three comes up a lot. I recently did an event called the three-legged stool, and this is not that. As a matter of fact, that's a fantastic presentation to watch. It's about 2 months ago or something, three-legged stool. That has to do with math and probabilities, understanding superior technical analysis, and psychology/experience. I think that's a great, one of my favorite presentations to watch because it really explains the total package that's needed to go into being a successful trader investor. Of which of those, you may not believe this, but to me, great technical understanding is only one of those three legs. So tonight we're talking about just great technical understanding. Okay? So this is all we're talking about. So don't confuse it. It's not that lecture. And I'm also not talking about the stupid, three parts of an entry, an entry, stop, target. I'm not talking about that either. That's just baby stuff. As a matter of fact, if this is how you're trading, if this is all you know, you probably are losing money if this is the only thing you can regurgitate about how to trade right now, right? Hey, Fire Tower, where you been? Fire Tower's in the room. He's been missing the last couple of days. I missed him there. I was kind of hoping you were going to talk about the concepts, right? Or finding. Okay. Sup? Oh, hey, how you doing? All right, so that's what we're not talking about. Here's what we are going to talk about. It's kind of how to think about the overall concept, the structure of what we're doing. So here are the three big categories. So here's what you've been waiting to hear. The three big categories of things in order to take any trade. Number one is to find what I call a picture of power. We'll talk about it. Don't freak out yet. Number two, the time frame of reference. And number three, you then find a great entry. This is what we need to do with any trade, investment, whatever you want to call it, we take. And again, just to emphasize, if you're a little newer with me, I like long-term trading. You may call it investing if you want. I don't care. That's fine. You can call it whatever you want. But when we take positions, whether they're holding for weeks or months or whether they're holding for minutes, it is, I call it a trade, and it is based on a chart. It has nothing to do with fundamentals or news or anything else. It has to do with the reaction to everything that's out there that is transposed onto a chart. That's how you do everything. So first one, picture of power. That is in essence why you are even looking at the particular trade you're looking at. Can anybody think of some examples of what I would mean by a picture of power? In other words, do you just go out and pick up any stock out there? You just randomly go, like you're pointing your name in a phone book and go Qualcomm. I'm going to trade Qualcomm today. What do you want to see? What do you want to see? Okay, so a picture of power, Reg, you have one of them right there. Hey, Carmen. Yeah, a picture of power could be a gap. A gap is one of the four things that can create a picture of power. Something that gets things moving. Something where it's not just the normal, remember guys, most stocks, and I'm going to give you 97%, which is not actually a made up number. Most of the time I make up numbers, but that's an actual number. 97% of the stocks you look at are just doing nothing. They're just doing nothing. I couldn't even begin to tell you where they're going to go. And one of the first things you need to understand as a potentially great trader investor is that most of the stocks you look at, you don't have a clue. We don't care, we don't know, right? So what I'm looking for is those 3%. What is in there? Right, so gaps are one of them. Gaps can change the picture, and gaps gives an edge because they do something to the chart that we can see on a chart that you don't see by looking at anything else. So it's very good. The next thing here, somebody said a trend, and I would phrase it a superior trend on the higher time frame. See, your strategy, whatever you're doing, is going to involve whatever you're doing. Whatever, I don't care what strategy you're doing. But what I'm saying is the strategy needs to have a picture of power. So if you're going to take some strategy, one of the things you would have to have as a requirement, according to me, would be a superior, higher time frame. So in other words, if you're taking a day trade, that's not okay with me if there's no reason for it other than the trend, and the trend better look good on a 60-minute chart, even if you're taking a 5-minute setup. If you're on a 1-minute chart, maybe the 15 is okay, but the higher time frame has to agree, support. There's a lot of different words we use in class. I don't want to go through the details that much or I'll lose you, but just simply to say that higher time frame must not only agree, but it must complement what you want to do, or you're not going the right way. A big bar, William, you're right. That's one of them. That's one of the four things. A big bar. We call them igniting bars. Bars, it's similar to a gap, but not quite the same. It's something where all of a sudden the direction turns ridiculously quick. And the last one, and here they are for you. Picture of power. Superior higher time frame, Carmen said that. An igniting bar, William just said that. A powerful gap, Reg said that a minute ago, and extreme relative strength or weakness. Now that fourth one is a little quirky. It's borderline. Again, these are not strategies. These are what you want to see as a backdrop to have the right to even say you have a strategy. And one of them could be superior relative strength. In other words, you're just cruising along on a normal day, and the market's strong in general but weak that morning. And here's this market stock for no reason, just consolidating at the high of the day. Well, you may have a strategy behind you that's called a breakout play or something, but see, again, to me, just a strategy hanging in midair with nothing around it isn't good enough. It has to be supported by one of the pictures of power. So if you could say, well, that consolidation that's happening, so the market's just kind of floating around here doing nothing, and my stock is doing this. Well, that would be a great form of extreme relative strength or weakness. So it would be a picture of power and would give you, in the wording I'm using, the right to play that strategy. See, there's strategies all over the place, but a lot of them don't ever work. And one of the reasons is you need, somebody used the word catalyst, I like that word, you need a catalyst to say, why is anything going to move? Why, because you break above that base, is it going to go higher? Why? It could just as well pop and get killed. How do you know? So I want something behind the scenes that's telling me there's a reason I should even be looking at this trade. Does that make sense? Yeah, a superior higher time frame. Well, William, I'm just going to talk about that. And see, here's the thing now, and this is where the line is kind of drawn, and I think you all know I'm very upfront about this stuff. I try, and if you're newer, I mean, I have set up in a way that I think an awful lot of people want to try to learn this stuff on their own. They either don't have time to like get training, so to speak, or they just feel they can learn it on their own. And that's what I tried to do too. So I support that to a large extent. And there is a free stuff page, and I make myself available to free members, which most, the vast majority of you are, that aren't subscribed to anything, that if you want to send me some trades or get together with me, I'm willing to do that to try and help you, in your endeavor. If you think you can make it, that's great. But I think you understand that it's at some point, when you try to say what are these four pictures of power, each one of them takes a lot of training to really understand. I'm not trying to blow smoke here just to make it sound like, oh, gee, you better get training to do this. That's not what I'm trying to do. All I'm trying to say is the truth of it is it does. And it's not even a matter. I mean, I'm here for an hour. We're going to be done in an hour. And like finding out what a superior hard time frame is. In the first Saturday class, I probably spent, what, guys, 3 hours talking about it? 3.5 hours, and then it's repeated a few times. But the point is, even if you sat through that 3 hours, would you then understand a superior higher time frame? The answer is no. You wouldn't really, because it takes more than just hearing it in class one time. It takes calibration. I mean, in other words, taking those words you learned in a class and applying it chart after chart and beginning to see the difference, right? And I'm not saying it's that hard. Please don't misunderstand me. I'm not saying, oh, gee, this is just something that's hard to learn. But I think it's only common sense to say you're not just going to listen 2-3 hours in class and just walk out a genius on Monday. I'm very honest about that. It takes a couple repetitions. It takes some follow-up with me, and that's what I commit to do to people, is to say, hey, we'll go back and forth and, fine-tune this, right? And I'm going to give you an example, as a matter of fact, of exactly that. And the best thing I can do here, we're not going to spend any more time on picture of power because, like I said, each one of those topics could be discussed for 3 hours or something. But let me give you an example of what I mean. Superior higher time frame. We'll come back to we'll come back to those just a minute. Picture of power. Superior higher time frame. I'm on a roll here, so I want to go. Here is a monthly chart. So here's a high time frame. So you're looking, and again, it doesn't matter what the time frames are. If you want to pretend it's a daily chart and you want to get okay for an intraday trade or an hourly chart trade, I don't care what chart you want to call it. It doesn't matter. But here is a time frame. Is that a superior higher time frame? In other words, is this time frame now set to support long trades because it is a superior time frame? Would you take a trade on this time frame itself because it looks like such a fantastic pattern? Would you think that this time frame, because it is, would you call it such a superior trend here, that it would give the okay to play anything on the weekly chart, daily chart that sets up possibly. Do you like this chart, in other words? Is this chart a nicely trending chart, yay or nay? Okay, now this is the reason I put this in here, and I'm not doing it to be a pain in the neck or whatever. This is right out of class. You notice the slide up here? It says from the DTS seminar program. This is a chart right out of class. And this is also not just something that I just pick up off the dirt and say, oh, gee, look what happened. I'm going to show us where we make them look bad. This is a chart that one like this, actually, that in real time in the trading room, I said, this is not a good trend. This is not going to work. Yeah, this trend is coming to an end. This trend is not supportive of going higher. And this is the small differences you have to see. See, if I asked all of you to give me your definition of an uptrend, I would get 72 different definitions of an uptrend, correct? Now, William, this was a good superior time frame. This was a good superior time frame up through here. And I just want to draw you a couple of lines here and see if you can get what I'm looking at here. Boom, 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 boom. What happened? Instead of pulling back where we should have pulled back, we accelerated. Anybody see that now? See, these are little nuances that make all the difference in the world. Do you see that, everybody? A clue, without even seeing that, is that these two are splitting apart right here. Do you see that? When that happens, that trend is going to end. That trend is going to end. That's what happens. Now, is that a pretty fine-tuned difference? Yeah, it is. But my point is that you would all have different definitions of what an uptrend is, and none of them will probably give you the picture to say, what is the point of knowing what an uptrend is? When does it begin? Where's the sweet spot? When do you recognize it may be ending? I actually had this trend. Actually, it was an exact chart like this. I had it in the room as a short watch, and somebody called me on it saying, hey, don't you have that in the wrong category? I'm like, no, that will fail after it tries to rally for a day or two. I never ended up trading that one. But this is a chart I use for demonstration to say that is just that fine difference between, a really good trend and not a good trend. So it just takes a little fine tuning to get that down. And it's like that for all of those four things. Let me go back to that because we have to do the rest of the slide. It's like that for all four of those things. An igniting bar, well, just a big green bar does not necessarily mean much. Do you know that anytime you're in a big downtrend, you get short covering sometimes and it creates a big green bar and then it just gets erased? Have you ever seen that, everybody? You ever seen a big green bar in a downtrend and it just keeps falling after that? Because there's nothing but short covering? I see that pulled away with the pullback, but you don't. No, well, that was a monthly chart anyhow, Reg. But yeah, Reg. Yeah, I mean, you would like to look at it, but that time frame is enough to say that pullback's not good anymore. Again, when you get to the top of that range, I'll show it to you again in a minute. Let me do it again. Let me stick here. That's in class too, Reg. It's a chart I do in class. Each one of these has some serious understanding to really get when a wide range bar. What do you have to see in a wide range bar to call it igniting, to say that it's going to follow through and continue in a direction, and when's it going to fade away? These are all things that are not one-line answers or one-picture answers. They're things that just need some reinforcement and some training and some back and forth. And even when you're done, remember, we're always playing odds in chart analysis. It's never an absolute. It's something that drives architects and engineers crazy when they try and learn this because they want exact numbers and precise percentages, and that's not how it works. It's as much of an art as it is anything else. Gaps. One of my whole classes is devoted to gaps. That's how important that is to me in a sense, because gaps are a unique opportunity. Gaps are a real, in fact, I'm going to show you a gap in just a minute, a unique opportunity. It's the picture of power I chose for an example here. So once you have this reason, you have this great time frame, you have an igniting bar, you have something that's happened on a chart that gives you a reason to start looking and following up, or when you find your strategy, it has one of these things supporting it. Well, the next thing becomes the time frame of reference, and this is one of the most difficult ones to explain or understand, but yet it is probably the source of more people having problems than anything else. I was going to ask you a question. Should I ask it now? No. So let's start with the time frame of reference here, it talks about it's based on support and resistance levels. It's based on location items. It's based on the expectation of your picture of power. And there's a question is, we have a wide range bar on the daily chart, let's say, or on the hourly chart. What do we do with that? How do we start playing it? It starts pulling back. But what time frame do we watch? Do we watch the daily chart, the hourly chart, the 5-minute chart, the 1-minute chart? What time frame is the time frame from which I'm going to actually drive my strategy and entry concepts? Let me start you off to get you warmed up. And then the third thing we'll talk about is the great entry. Excellent. Well, on the great entry part, as long as they're finishing the outline here, if you are really great with 1 and 2, picture of power, time frame of reference, it allows for really aggressive entries. In other words, if the more you get to know the chart, the more you get to say, you know what, this chart's powerful. You know what, this is exactly where it should be. The more you know 1 and 2, the less you really have to struggle with an entry. Does that make sense to anybody? It may not make sense to you because if you've gotten any training or tried to self-teach, you probably have learned that entries come from the strategy, but they don't really. I teach entries as a separate concept. So it's not tied to the strategy per se. So the more you can be great with number 1 and number 2, the less critical your entry becomes. The best purpose for an entry is used when you're least certain about number 1 and number 2. And a be the tail, it's called a be the tail entry. It's one of the entries that you just always the best if you can identify the correct area. We just did this picture of power chart. Reg, I didn't have the chart at the time, but to answer your question, all you need to see, you don't need any other time frame. See, when you have this, you should pull back. You continue in a linear fashion, right? And then you accelerate. That's the top. Whenever it rolls over, that's the top. You no longer buy this chart pattern. Not on this time frame, not on the next pullback. It doesn't mean that it'll fall forever because it's a super strong stock. It just means it got carried away from itself and it's going to have this hiccup in here. It's going to do this. It may recover sometime. You can play it down the road a few bars, whenever that is. Somewhere in here it'll recover. But that next, and this is a very common thing. You may say, well, gee, whatever time frame that is, but this happens all the time. Intraday, we see this 100 times a day. Recognizing when a stock has topped out, and it may be because you're looking to see an extended stock, when to short it. As a matter of fact, this concept here, again, it doesn't matter what time frame you're on. It doesn't matter at all. This concept here is exactly what I want to see when I'm trying to short an extended stock in a resistance at reversal time. Right, room? Some trading room people here with me? That's exactly the type of thing we look for. That acceleration into the area we're looking for. That's like the ka-ching, gimme, gimme, done. So these concepts prevail throughout everything. Time frame of reference. It says, here's a warm-up. And I think this is a very simple concept, but I think it will hit home with a lot of you because it kind of introduces the question, so to speak, about the time frame of reference. Go long here. What do we think about that? I gave you multiple choice up there. A, stupidest trade in history. B, depends where the VWAP is. C, might be a great entry. D, good as a climactic. What do you think about going long right where that arrow says? This would be the time where you guys type wide range. Boy, it's a good question by the instructor when you get a wide range of answers. D, D, A, C, A, C, D, C, all over the place. All over the place. Okay. Well, there's a point to it, and I want you to watch this really carefully. I took a couple of minutes here. I took 5 or 10 minutes of my time here to develop this slide so that it shows you something. Watch this slide here. Okay. So it says next. What does it say next? This is about 25 bars. Yeah, just watch for a minute. Stop typing it. Just watch for a minute. This is about 25 bars. So let's say they were 2-minute bars. Okay, again, it wouldn't matter. Remember, it never matters what time frames you're talking about. If you want to pretend that's a daily chart going into a monthly chart, I don't care. But I'm going to say these are 2-minute bars. So this is about 50 minutes worth of trading, right? 25 bars times 2. Anybody check the math on that? 25 times 2, 50. 50 minutes of trade. So watch this 2-minute. Now, I think we'll all agree this is in a downtrend. I'm just going to tell you that. That's not a trick question. So we're in a 2-minute downtrend. So watch that 2-minute downtrend. What if this? Watch it. Watch it. Watch it. Shrinking, 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 shrinking. See that 2-minute downtrend? What if this is the 15-minute chart? Now, the point is, I didn't, respond to any of your answers. The point is not it's supposed to be a trick question. The point simply is this. If you're buying a pullback, what percentage of the time will the smaller time frame be in a downtrend, everybody? That's a real question. If you're buying a pullback, so here's a pullback, what percentage of the time will it down? Yeah, 100% of the time, right? And this is what we're really referring to is the time frame of reference, right? The time frame of reference. And that is to say that on the way up here, maybe you were playing the 2-minute chart, right? I'm going to repeat this later on another slide. Maybe you're playing the 2-minute chart, right? And all of a sudden the 2-minute chart stopped working. What do? Well, number one, you stop playing the 2-minute chart. You get in your helicopter and you zoom out and you look at the forest and not the trees anymore. Now remember, while it's perfectly legit to be playing that 2-minute chart all the way up, right? A good trader will start to understand the time frame of reference here is going to be the 15-minute chart, and you're probably going to hit some area where that 15 is going to start pulling back. Now you may not ever know it, and it may be just that when the 2-minute chart breaks, maybe that is what shows you the top on the 15. But once it breaks, you don't keep playing the 2-minute chart. You don't keep going, oh, please work, please work, please work. You group back and you say, okay, you look around and you look at the support resistance areas, moving averages, the retracements on the higher time frames, and you say, which is the time frame that's driving this pattern? And you look at the 15, you say, you know what, the 15 is the chart. This is the one that makes sense based on what we teach in terms of location items and trend. So once this 2-minute chart breaks, you step back, you don't short the 2-minute chart in a 15-minute uptrend. You don't do that. That's stupid. You wait for here, and then when the 2-minute trend ends, you go back to playing the 15-minute chart. And there's a lot of ways to do that. I'm not getting into all the different ways you can do that. But does that make sense, everybody? This is just the first most basic concept in terms of what the time frame of reference is. It sounds very simple when I'm saying it, right? But when you look at your trading, I get so many people that this is what they do wrong. They just kind of don't get this. So that would mean that this actually, it is not that it is okay to buy downtrends. It's simply that this is not the time frame of reference. And this is something I get all the time in the room. I'll be buying a pullback on whatever time frame, and somebody says to me, Paul, what are you doing? You're buying a downtrend. I'm like, what are you talking about? And they're looking, a lot of people that come to trading rooms, they live on 1 and 2-minute charts because somebody told them that's where you should live. And that's all they have up. And they're like, oh, you're buying downtrends. You can't do that. Well, okay, yeah, this is a downtrend, but you know what? I can tell you it's going to end. And oftentimes we'll be jumping in before this downtrend actually ends. But remember, if you're in the right area, the 15-minute chart, when the 2-minute downtrend ends, you know what? That can be a fantastic entry because that's the best confirmation you can have. When you look at it from there, that entry doesn't look so bad anymore. This is right out of the slide I did for the seminar people. And again, I'm going to go through it rather quickly with a little different set of goals in mind. But it just kind of shows you what I just did in a different way. And maybe when I show you on a real chart, maybe this will start to ring some bells with you about maybe stuff that you guys do. Because I think some of the most common, chart suggestions I get are these type of things where my answer is I would never enter that. I would never consider that trade you're doing. And they usually revolve around these areas that they're just not keeping all the time frames of reference in mind, and they're taking trades to me that are just way out of line. And it may partially work, but then it's about to fail miserably. So this is a set of 4 charts, and it may be a little confusing. This is a daily chart. This is a 60-minute chart. This is a 15-minute chart. This is a 5-minute chart. Okay, and it's all stopped at the same moment in time here. Okay, so we are in the middle of a rally, in the middle of a day on the 15-minute chart, the 5-minute chart, boom, 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 60's up in here. Okay, so let me pull my slides up with this. So the question here is, look at the 5-minute chart. 5-minute chart has been in a nice uptrend, correct? So my first question to you is this 5-minute pullback an acceptable long on the 5-minute chart, right here by the red dot? Any comments on that? Would you say that's an acceptable pullback? By the way, I'm not going to have a real hard answer on this one, so don't worry about your answer too much. There's a different point to it. If it's a no, why no? By the way, I have no problem playing this daily chart long. I don't have an issue with that because that I consider that a picture of power that's gapping over that red bar in the pivot. So the daily chart gives a big thumbs up for playing long. So I mean, I don't think that's an issue here. But just based on the other time frames there, what do you not like about the 5 minute chart? Yes, yeah, you're now seeing, excuse me, you're now seeing the next day exposed on the 5 minute chart, and the other charts you don't see them yet. We're just still at the end of the day here. So I have exposed this much of the 5 minute chart. That's all you're seeing. The rest of the charts are behind you. Yeah. Because if you saw the other charts, you know what was going to happen. So I can't show you the other charts yet. Yeah. So we started the new day. The 5 minute pulls back. Boom, boom, boom. So the question is that a good 5 minute buy setup? I'm going to move on here because you're saying no, and I would agree. Right. I would agree that I wouldn't like that. That's not really the point of my question though, but it's the same reason, right? I mean, you started to accelerate, you started to spread a little bit, and then you gapped up, right? And after that long run, that usually is going to end the trend. But here's the point of it though, right? Let's say you did take it, or let's say you're watching this because you love this daily chart and you want to get into it. The point of it is this: if it fails, what do we do now? So the 5 minute buy setup didn't work. So do we keep playing the 5 minute buy setups in here and hope one of them works? What do we do? I'll give you a hint. I gave you the answer about 10 minutes ago. Right. Well, Robbie, what we do? Hey, Robbie, how are you? We back up and we look at the time frames and we decide what is the time frame of reference. In other words, what time frame is still making sense? As you go and you move, time frames become extended, extends the next one, extends the next one, and pretty soon it may be all time frames need to pull back. But sometimes the daily chart. So you step back and you look, and again, the answer to this question is where you need your superior technical analysis skills. So if you're not really understanding, Paul, what do you mean? That's okay. The answer is you look for the proper time frame. What is the proper time frame? Well, that's what you have to understand about what time frames should look like, how they move, the retracements, the acceleration, all that good stuff to know where you should be. So you come to the 15 and I say, well, I'm not loving the 15. And once you break the time frame you're on, you got to step back and say, what am I doing? If I'm taking a day trade, and some of you may not know the answer to this, if I'm taking a trade in the 5 minute chart, what is my parent time frame? What time frame do I look to? And I have to write a little note to say, dear Mr. Chart, will you allow me to go long? What is the time frame that is the governing body for all intraday trades? The one that has to make sense, the one that has to be in the right spot, the one that is the parent time frame of right, the 60, right? So look at the 60. If we have broken down on the 5, do you want to go long on the 60 right here? Anybody want to do that? I have zero desire to go long on the 60. Zero, absolutely none. Now, this 5 minute chart started moving, right? And as long as this thing stays intact, if you want to keep playing it wherever you are on this 60, I'm okay with that. But keep in mind, the more and more you go up this 60, the more likely the 5 will bust one of those times. Does that make sense just from, at this point, just from the school of common sense? Does that make sense to all of you? Because things don't go forever. So the more you go up the 60, the more likely this 5 is going to break at some point. So, but I don't care if you play it until infinity, but when it breaks, you stop and you say, okay, where are we? And you say, you know what? When I look at that, and if somebody were to ask me, when can I play the next 5 minute buy setup? I'd say, can't even tell you. I got to wait for that 60 to come into place. So in other words, go to the next chart, go to the next chart. We just keep going sideways. You may say, oh, gee, there's a 15-minute breakout. Somebody could call it that, right? I'd say, no, you're an idiot. It's not a 50. Why? Because look at the 60. You can't play the 60 long up here. Now, could you show me a chart where that worked one day in 1942 on a cold winter's day in southern Afghanistan? Yeah, maybe it did. But you know what? I'm not interested in that. I'm interested in the odds. The odds are nothing's going to work up here. So, and it also has all the indications of a stage 3, which is beyond the definition here if you don't know what it is. So you wait, and you wait until you start seeing this. Here is the right location on that hourly chart. This is where you first would start to begin to say, okay, hourly chart players, here you can start looking for your entry. If you're a smaller time frame player, the hourly chart is now in an area where I can come down to the 15 or the 5 and start to find my possible entries. This could be one forming here. We have a wide range bar off the bottom. I want to see the reaction of the wide range bar. Secondary breakout of that bar, possibly a consolidation inside that bar, are all possible entries that are now justified as a preemptive ending of the 5-minute downtrend because we're now in the right area on the 60-minute chart. Does all that make sense, everybody? I said a whole lot of words there, right? Yes, Reg, based on retracement, based on minor support. Exactly. And of course, to even consider that 60 to be acceptable, my daily chart can't be negating the trade. Now that, again, some fancy language, but it's my language. But what it means, the daily chart has to at least say, okay, I'll let it slide. And it does, because I'd actually be bullish on this daily chart to some extent because of the gap that happened back there. Okay, so there's more of an example. And this is, I should have said this at the beginning. I apologize, I did not. But this is kind of a higher level technical talk tonight. So I mean, if you've not had technical training at all, a lot of this may be a little, a little out there, like what's he talking about? But you get the concepts. I think you wouldn't be here if you didn't have some interest in the concepts here. So I'm going to go over this next one real quickly. This is actually a current long-term position I have, and this is showing a bigger time frame, but it's the same exact type of concept. And that is, well, here's the point I want to make on this one here. The star here on that daily chart is the star here on the hourly chart, same moment in time. That's there on a monthly chart, it's there on a weekly chart. Okay? So a similar conversation. Do we like this daily buy setup coming off support? And I'm using the daily buy setup in support. I'm not, in quotes. I'm not giving any special language to it. Just would you go long in here? We've been in some kind of a daily uptrend. You may like it, love it, hate it. I don't know. It's been going up. This pullback here, would you like this to go long here? Yes or no? Again, I'm not all that worried about your answer. Would you like it to go long there? And yes, no, why not? Well, how about just right on this chart? How about just on this chart? There's a reason I could see you wouldn't like it. And that's that it pulled back a little more than it had been pulling back. We kind of barely made a new high. But again, here's the point. Whether you liked it, whether you hated it, whether you loved it, the point is that as we go on in time, watch the stars. I'm going to move everything to the left. No void to the left? What do you mean no void to the left? Anytime you play a pullback, Jerry, there's no void to the left. Zero. There's 0 times there's a void to the left. The prior high? There's no more resistance there than there was here or any of these. That's not an issue at all. Low of red bars? No. Yeah, no, that's not an issue at all. But watch these stars. I'm going to move everything to the left a little bit. Okay, so watch hourly chart, daily chart. Boom, move it all to the left. Got it. Okay. So there's that pullback we were talking about. Okay. And it failed. Now, here's my point of the thing. Whether you liked it, hated it, loved it, whatever, we've been in a nice weekly uptrend. We've been flying higher, and all of a sudden, the daily chart trend breaks. And I'm using breaks just in an English language term, okay, not as any sophisticated trading term. What do we do when the daily chart breaks? Well, same answer. What chart is the chart that is really driving this pattern? Well, the monthly and weekly charts are very similar. I want the weekly chart to return to this area. So I'm not going to touch this daily chart long until the weekly chart comes down to this area. Everybody see that? And now once the weekly chart is in this area and I know it's stalled, now I have multiple entry opportunities. I could try and get in the bottom of a daily area in here. I could try and take the breakout. Now this is one of the trades I have long term right now. This is BHVN. And I actually took this one. I wish I got the bottom. I took it on that little gap up day right in there. This is up like 9 R's or something. Check it out on your chart right now. BHVN. It's flying higher. So this is an actual thing that, and the reason this is so easy for me to do is because I was watching this a long time, and I was watching this pullback, just watching. It was on. If you guys had come to the Monday night biweekly scanning sessions, this was on the list for weeks / months. On the bullish list, watching, and finally I got the entry on it, and it all paid off because the thing is just flying higher right now. I still got it. The last part of it. So there's time frame of reference, and again, even when you know all the technical stuff, this becomes difficult for people. If you have a big, and there's a lot of stuff I didn't, there's tons of other examples I didn't even put on here, but I mean, if you have a huge breakout bar, right, boom, you just break out of everywhere. And you start pulling back. Do you buy the 1 minute buy setup? Or if that fails, do you buy the 5 minute buy setup? Do you wait for the 15 minute buy setup? Or you wait for the hourly buy? What are you waiting for? All right, that's all this whole time frame of reference talk. It all is which time frame is making sense based on the power of the move that just occurred, what you expect from that picture of power, where the retracements are, where the moving averages are, where you have pattern failure occurring. All that stuff is what you have to look at. It's a bit of an art and an education, and that's why, again, I emphasize that even though I'm showing you all this stuff, the underlying knowledge is what's needed to really identify what's going on here a little bit. And finally is a great entry. Find a great entry. So I have some slides. I don't even remember what I said here. There are two types of entries. Now, again, for me, I teach entries as a whole separate concept. Entries have one of two purposes. Does everybody know the number one chief purpose of an entry? Most of you should know this by now because I ask it fairly frequently. What's the number one purpose of a great entry? Which would be one of the two purposes, one of the two types. What does less risk mean? What does that mean, less risk? You mean you lose less money when you lose, or you don't lose as often? You able to put in a stop? Well, I can always put in a stop, right? Stop loss is closer. You see, Shandu, if you're saying that, I just want to take a moment to explain this because I think that is like one of the worst comments I have to hear. Because to me, and again, this is the world according to Paul, so forgive me if you don't agree, but to me that is just a really, really, really poor way of looking at things. Because if your stop is closer, you're simply going to stop out more often. And the way you should be trading is that you should be risking the same amount on every similar trade. So by putting your stop closer, you're not making money, you're losing money at a faster rate, right? Because you're going to stop out more. Anytime you put your stop loss closer without any other knowledge, it's going to stop out more often, period. That's just a mathematical fact. So that means you're going to lose your $500 5 times faster than somebody else. And then you may say, well, I'll put it closer and use less money, right? But then why are you risking different money on different trades? That is really a poor habit. So you really should be, and again, if you come to the Friday free class I'll be doing December 4th, I get into this more, but you really should be sizing things so that any trade loses the same amount of money. And then that stop should be sufficiently far away so that you don't hit it unless you really should be hitting it, okay? Yeah, so obviously the entry will determine where your entry and stop is, so it will determine your risk reward, but all that is just math. The chief purpose, the number one purpose of a great entry is what many of you said, is to keep you out of a losing trade when you can. It's to keep you out of a bad trade. In other words, if you just jump into a trade, you're going to be in it. And if it doesn't work, it doesn't work. And entry should hopefully be helping you to say, hey, let's wait a second on that entry and let the stock prove it can move higher. Here's the way to think about it, like Shandu, everyone. Have you ever gotten into a trade? Let's say you're doing some kind of breakout or something, okay? I draw a little consultant. You ever get into a trade, it goes up a nickel, maybe as a day trader, and then it comes back and you're sitting here, you're still in the trade? You ever had that happen to you? And now you're sitting there down a little bit the whole time? And you're thinking, okay, I'm still in the trade and I like it. In other words, I didn't do anything wrong, but I wish I wasn't in it now, because if I wasn't in it, I'd get in over that number there. I'd spend the extra nickel. Does that make sense, Ruben? You ever been thinking like that? Like, I wish I had that entry back because for a nickel, I'd rather be not in it and then get in over that number. Well, that's what a great entry should do for you, is not get you in that unless it's starting to move. That's one of the concepts of a great entry. Now, that's easier said than done. I'm not saying that every time you automatically, can do this, but that is the goal of one of the goals of a great entry. So what does this wonderful slide here say? It says, think about it. If you're good at the first two things I talked about, your entries can be more reliable. When do you, here's a question for all of you too, something that should make you go, and think about it tonight if you're not as happy as you want to be as a trader. When you do stop out, I'm not asking how often you stop out. I'm saying when you do stop out, even if it's once in a year, when does that typically happen, everybody? Does it happen fairly early in the trade, or does it happen like closer to the end of the duration that you expected to be in the trade? This is like a 95% agreement answer by everybody I ever asked, right? And I agree with the answer too. It's early, right? You get in and that wasn't right, and you're out, right? It happens early, right? Well, let me ask you something. What causes that? Why is it that everybody who gets in a trade gets out early? What is the cause of that? It's a pretty easy answer. Got in too early. Yeah, right. You typically people are a little impatient, right? They took the first little bounce. They're afraid. You know what you have a lot of times as a trader, right? You ever have that? Having that is the worst thing you can have because it just makes you chase stuff to your detriment, right? It's fear of missing out. So you're afraid it's going to move. You jump in, and then the real pullback comes, right? And then of course when it washes, and I like that as a trader. No offense to any of you, don't be mad, but I like that because when you get washed out of the trade, guess what? When you get washed out, I'm getting in. And that's the time to get in because now you guys are gone. You're not screwing up the trade anymore, and then we move higher. So when you think about that, if you know that's a fact for you, right there, if you know that's a statistic for you, why don't you just automatically do something about it? Why don't you take a look and say, why is it that all my stop outs come the next bar after I get in? You would quickly realize that your entries are not very good. Your entries are always chasing type entries. I'd have to say one of the most common things I see in newer traders is that their entries are terrible. They're chasing things way late, and the only way they can make money is if you just have a home run move. And when you get the home run move, great. But you know what? Most of stocks don't make home run moves. They're just kind of, meandering out there. And if you don't get great entries, you're not going to make money. The strategy gives you an area of probability, right? That's the point of a strategy. Whatever your strategy is, I don't care what it is. If it's the ipso facto inverse law of proportion strategy, whatever it is, boom, you decide at some moment in time you have this area from which you're going to blast off, whatever it is, whatever that area is. And you get in that area, and boom, now is where you start looking for an entry. Now, an entry, like the slide says, should be a separate concept with unique goals. Your goal of an entry is going to vary with how much you love the setup that you have. Some entries should have the goal of getting you in as early and as easily as possible. Some entries should have the goal of keeping you out unless you're sure you're moving in the right direction, because there's going to be a varied amount that you love the area you're in for that exact strategy you're on. To me, entries are just absolutely everything. And I go around with this people sometimes, I'll always get emails, oh, I don't think the entries are, no, the entry is everything. 20 years later, I'll tell you, the entry is everything, period. The entry is everything. What's the most important part? The entry is everything. Because I don't have time to go through all the different aspects now, but it's just everything for a whole bunch of reasons. And I've done it in other presentations. If you've seen some of the other presentations, you've probably seen me go through the concept of when you get the wrong entry, how it can completely screw up the trade, even though the trade works. So let me show you an example of entry. And I just happen to have, I'm very fortunate sometimes. I just happen to have a perfect example. I had to throw this in here today. I was sitting here working on this and joking around with the room today. Oh, we missed you, Fire Tower. We had a riot going on in the room today. But this is an example encompassing the three things I talked about, the three parts of every strategy, right? A picture of power, time frame of reference, and find a great entry. So this is right off the charts from today. This is a gap down on low today. If you have your charts up, you can take a look at low gap down today. It was a favorite for me today. One of the reasons was because we were in a very sideways market the last 2 days. The watch lists were not good. I really wanted to find a nice gapper because gappers tend to be on their own page. And that's what I wanted to see today because the market itself was just messy. So perfect low gap down. There's your daily chart of low. So I start off with the picture of power. Do I have a picture of power on low? Yes, I do. I have a tier 2 gap. So right there, in other words, what that means, as I go through low, I'm going to try and take the language I've said to you and just put it in simple English, okay? So I have a tier 2 gap. In other words, I would have never had low on the screen today, right? Yes, I did, sir. Well, pretty close. Pretty close, FT, best I could. But I would have not had low on the screen today. Well, actually, you could have. It was an interesting pattern. But the thing was, it was on the gap list. That was the picture of power. So it says, okay, this thing is gapping. Now, again, 90% of the gaps don't mean anything. Remember, when a stock gaps, it is actually opening at a point where it is in perfect balance and harmony. So there's not necessarily odds just because it's gapping up or down. But this one here gives us some telltale signs. And the little clue I say here, a lot of people are wrong. In other words, when you look at the low chart, there's a lot of people who were long, long, or long, long. Matter of fact, anyone who's long in here, for any reason whatsoever, remember we go across all time frames, day traders out to long-term investors, guess what? What do all those people have in common today? Every one of them, going back 3 months, what do they all have in common? They're all losing money to one extreme or another, right? And I have another little secret on this chart. See, again, this is understanding the language of charts. There's an abnormally large number of people that are in pain. And the reason is because of that bar there. See, when you have a huge red bar like that, if you're a swing trader, whatever, you come home at the end of your workday and you're down here, right? And what do? You just say, oh crap, right? You say, oh crap, look at that. So you maybe put a stop loss in here, right? And then you start grinding up, and a week later you go, okay, thank God, I'm going to be okay. It's going to grind back, and all of a sudden you wake up one morning and boom, here you are. Everyone in here is in some sort of pain. Now, there's always a balancing thing going on with gaps. There's always something on the other side, and it was a fairly large gap. So the next thing becomes, what's my time frame of reference? Well, on a gap, because you're going to trade it that day, there is no prior pattern to refer to, right? No need to ask that, FT. Thank you, Andres. Right, there is no prior pattern here. Here's the 5-minute chart. It's starting over today. You can't even see the prior price pattern, right? So where do you get your time frame of reference on a stock that gaps? Anybody? Even seminar program members? Here's a 5-minute chart. We're a light year away from the last 5-minute chart because we gapped down, right? So there is no other chart pattern to look at. Where do I get my time frame of reference then? No, Carmen, the daily chart's way up here. How does that tell me? Should I be on a 1-minute chart, a 5-minute chart, a 60-minute chart? Exactly, Jay. Jay has it exactly right. It's part and parcel with the gap understanding. In other words, those of you that take class, right, we know we rate the gaps in tiers. And based on the tier gap, it tells you what time frame you should be looking at, right? So I know for this type of gap, I can be looking at a 1 or a 2-minute chart, and I can be looking early in the morning. And the language in English is that I need a good second. Jason, beautiful. Where are you from? Boy, I need a decent secondary sign of weakness. Exactly, Jason. Yeah, that's what I need. A tier 1 gap, I need basically nothing. It's just get me in there. Tier 2, I need some secondary sign of strength. We got to finish up. We have 5 minutes left. So picture of power tells me that I can get in here short as soon as the little buying spree gets over. Now, we don't always run up. Sometimes you run down. That's a little trickier. But I love it when I want to short and I turn green. Because when I turn green, I say, I gotcha. So you can't see on the 5-minute chart really right in here, but I got you right in here under 152.50. You can see the numbers down here. Entry 152.49, stop 154.01. I'll show you that there's the targets. The gold stars are targets. So one target taken on the retest of the low of the day, and it was a full R, so that was okay. And then target 2, see that accelerated move down there? Art told me to take that one. I would have held the back 2/3 the end of the day, but Art said you got to take some there. I said okay, fine. And then the last part was held basically at the end of the day. I trailed out the last 5 minutes before, but so you can see the targets and the time. So that's the exit time, 3:33, 3:45. Nice R gains. And by the way, how do you manage this? I know in hindsight it's easy to say, but how do you not just take your profit here? How do you hang on to here? How do you do that? How do I do that? I leave the room for a good part of the day. Yeah, exactly. Now, I had to hang around today because I had to do this stupid presentation for you guys. So I had to hang around a little bit today, and that's why we were all talking and stuff. But it cost me a little bit of money to sit there, but not, it wasn't too bad. It wasn't too bad. And it was fun sitting there with you guys. So here's the, so there's, I'm sorry, there's the entry, stops targets. You can see it down below there too. And then to zoom in a little bit more on a great entry, well, here's the 1 minute chart now. That's a zoom up of the 1 minute chart. And I got in right as to see this thing became a tail. That's where it sucked me in because I thought it was going to drop right there. It ended up going a little bit more, but that doesn't affect me because my stop's up at 154. Don't care. So my point is just that this was not a trade from 1987 when we had a drought and I was playing rice paddies. This is a trade from today. I do this stuff every day. This is an entry that I consider to be a great entry. I'd call this a great entry. I did it. It's a great entry. Sometimes I have terrible entries. This is a great entry. Why was I able to do a great entry? Because I understood the picture of power. I knew my time frame of reference, and I knew when this stock opened, I knew exactly where I wanted to get in and how. Now, naturally, I don't know exactly what's going to happen in the opening 10 minutes, but I know what needs to happen for me to enter. When it happens, I get in. And that's how you trade well. Oh, Mark, I did lower the stop along the way several ways, yes. But let me show you the difference on that real quick. See, when and forgive me if I don't have this exactly right, but again, all the room members are here. They'll tell you if I'm lying. But I lowered it when I was somewhere down here, Mark. I lowered it to here. When I was somewhere down here, I lowered it to here. In other words, I knew a target was end of day. So I'm not sitting there on a 1 minute chart trying to find every little nick and pivot because I would have been out, right? That's why I said back here, like you could have maybe trailed it there. There's all kinds of spots you could have got out when you didn't want to. And again, it depends on your target. You have to manage in a way that can get you to a target, right? It's just like what I will say. If you're taking a swing trade, you can't get to a $10 target on a swing trade over 5 days if you're going to manage on a 1 minute chart. You have to have an appropriate method to get there. So I'm very kind of laid back. So it's when I get to a point, when I'm down here somewhere, I'm saying, okay, there's no way I want to be up here anymore. That's just not going to happen. Right, Andre. It's the only way to get multiple hours. Exactly. Exactly. So 2 quick things for you. Every time I show this slide, somebody goes, oh, wow, I never heard of that before. For those of you that want to day trade and don't have the capital available, if you don't have the money, period, you shouldn't be day trading. But if you have it, but it's just not available liquidly, there is a way that you can day trade without having $25,000. It's called prop trading. You could be trading in 2 days if you want to be. You have full control over your money. It's not levels or stuff like that. It's not my program. I don't do it. I'm not involved. It's a reference I do because these people are excellent. I've worked with them for years now, and they are just superior. I've never had a bad thing about them. Your money is safe in New York, Chase Bank, and you don't have to take any tests or go through any hoops. So it is the perfect answer. It's all legit. It's good stuff, or I wouldn't be showing it to you. Email me if you. Andres is in the program. I forgot you're even in that, Andres. Andres is in the program. He says it's great. And again, you can lose all your money if you want to. I mean, that's up to you. But it's your ability to trade with starting with $5,000. You get 10 to 1. And let me get my email out there. You need to email me for this. No, I don't. I mean, I personally, I wish I did years ago, William. I don't need one with them. I'm actually thinking of actually doing one with them just for demonstration. Because one of the things I want to focus on next year, I think, is kind of really trying to work more with just brand new people. Because you don't have to be any type of pro to be trading the market. As a matter of fact, I've said from the beginning, and I'm more and more stubborn on it, I think my best students are people that have never been in the market. It's just new to them. They just do well. And I think it's something we all should do. Old folks are good too. I didn't know you're an old folk, Jeff. You sound like a young kid to me. So email me if you have any questions about that. If you do so happen to want to take the DTS seminar program at the same time, there's a little package deal. It's not a real big deal. It's not like I'm trying to convince you to do it. And you don't have to. You can just go take this prop program, nothing to do with DTS. I'll help you all you want to with it. But if you do want to also get educated along the way, there's a little deal. There's not a big deal. For those of you who are newer to me, every 6 weeks I do the seminar program. The seminar program itself is paid for, but the first class everybody's invited to is called Introduction to Mastering Technical Analysis. If you like the stuff I talked about here tonight, you'll probably love that class. Make sure you're here. That's going to be Friday, December 4th. You will get invites to that. If you're here, it's because you're a member and you'll get invites automatically. And then the actual seminar program starts December 5th. There is one more cycle to the seminar program. Um, if you are so interested, make sure you check out the free stuff page. You guys are all DTS members already, or you wouldn't be here. Check out the free stuff page. Great source for information if you want to keep dabbling on your own. Thank you, Marty. I always appreciate the comments. There's that, there's that. And if for those of you who are interested in understanding what the seminar program is about, let me give you the link to that. The seminar program, it is of course only taught by me. It is my commitment to you to get you to understand this stuff. It's more than just the classes. It's an ongoing program with additional follow-up lessons, your ability to work with me and to get you to understand this. I'm very proud of the people who have been through it, and a lot of them doing very well. There's no guarantees, of course, but for a lot of people, it's they love taking it. Oh, thanks, William. I always love that comment too. Felt like I spoke right to you. You know why, William? Because I know what everybody's been through. I've been through it. I work with people for years now, and we're all the same. I mean, 99% of us are all the same. You go through the same stuff. I can tell you most of the emotions you go through trading, where you're screwing up, what you're doing wrong, because we all do it at some point. William, have you watched The Three-Legged Stool, William? I think you're new or I don't recognize your name. Watch The Three-Legged Stool. Go to the free stuff page and watch some of those videos. The Three-Legged Stool is one that I think everybody should watch if they don't get it, because it just kind of puts technical analysis in perspective. It's mandatory to understand technical analysis, but you can still fail if that's all you know. Yeah, unlimited retakes and seminars, of course. I don't want to go through that. They can read about it, Chip, or ask me. They'll figure it out if they're interested. You know what? If they're interested, they'll get a hold of me. If they're not interested, they won't. Thanks, Randall. You sound like you're newer too. I don't know your name. Sorry if you've been around, but I probably am a much different way of looking at things. I am. Because a lot of what you read, Randall, I hate to say it, but a lot of stuff out there is just kind of the status quo, things you're supposed to say that doesn't really work. I mean, it's just written by a lot of people who, quite honestly, aren't very good. And a lot of stuff you read in books is not necessarily, I mean, a lot of the basic stuff is the basic stuff. It's okay, to say this is support, that's not wrong, but does that really make you any money? Some things, Randall, like, you'll get, if you listen enough, you get to hear me say, probably one of the biggest things that costs you money when you start off trading, well, not when you start off, but when you develop as a trader, one of the things you have to wrestle with is that the number one killer for people, in my view, is stop losses. Taking your stop probably puts you out of business. Now, I'm not saying you don't take a stop. Don't ever get me wrong. You have to have a line in the sand somewhere. But the way most people use stop losses, it drives them out of business. It has statistically been found, more and more studies are out showing that following your stop loss ends your trading career. It's because you do it wrong. It's one of the biggest parts of my second class is understanding what a stop loss is for and how to use it. Just like somebody said earlier tonight, oh, if I'm unsure about the trade, I'll make the stop really tight. Well, that's completely backwards. It's completely 180 off the chart backwards. It's the opposite of what you should do, but yet that's the nomenclature out there people say. Oh, well, you're not sure about that trade, we'll just make the stop tight. What sense does that make? If you're not sure there's a bullet in the gun, use a 22 instead of a 38. What difference does that make? It makes no sense at all. It's just wrong. There's stuff that's just wrong, and you have to get over that stuff. Randall, I do have, like, that stuff is not like what you'd call top secret stuff. There's a lot of that on the free stuff page, Randall. You're welcome to go look through. I mean, you can look at the titles and kind of figure some out. There's ones on management. Specifically, they have the word management in them, which would be dealing with some of that. There's some where I talk about how stop losses hurt you. And again, don't get me wrong. If you don't have a stop loss, you'll be out of business. But the way people use them is so backwards and so misguided that it takes a trader that's finally starting to develop and it puts them out of business. And part of the reason is that it's the psychological backpinnings to the stop loss issue, right? It's a psychological thing. So much of this, when you get through to the other side, Randall, you look back and it's kind of common sense all of a sudden. You go, how could I have been doing that? And that's why sometimes I get frustrated. I'm like, you hear me, my voice sometimes, like, what are you doing? What are you doing? Because when you're on the other side, it's so simple. And before you get to the other side, it's all just a blur, and that's what I try and help people do. Okay. All right. Great, guys. Oh, yeah. Yep. You got to draw a line in the sand, Penny. Absolutely. James, you got to draw a line in the sand. Absolutely. But it is absolute a statistical fact now that most people drive themselves, well, they paper cut themselves. When you're new, if you don't use a stop loss, you die a sudden death. You wake up one day and your account's gone. When you get experienced and you start using stop losses improperly, then you start dying 1,000 paper cuts. Anybody that's still here listening to me, do you understand? Have you experienced dying of 1,000 paper cuts? Do you understand what I'm saying? Just with that, I think that's a pretty good expression to explain what most people go through at some point. When you get good, good means you die of 1,000 paper cuts. It's like you're always hopeful, right, guys? You're always hopeful. It means you constantly have tons and tons of small losses, Ricardo. It's like instead of like just blowing out your account in 2 months, you blow it out in a year or in a year and a half, or you just get so bored because you're just losing a small amount of money because you're afraid to make money. You lose small amounts of money because you're afraid to make money is what it comes down to. Well, if you start off the right way, Jay, right, you don't have to really have significant pain, not in terms of financial pain. You should have a lot of emotional pain in the beginning because when you do things wrong, you need to do it right. But hopefully the emotional pain only results in small financial pain because that's how you should do it in the beginning. Right. Yeah. It's all part of, we even go over that on that Friday class. It's all part of, what I teach. It's very, very important. And it's another good one that is discussed a lot in a video that actually is now it's back on the free stuff page, but it's on the archives to the free stuff page, a little button on top. But it's called From Chart Reader to Trader Investor. It's another super important one to get. With futures, though, you can get all the points again. Yeah, right. Well, yeah, right, James. Futures just, they're just very leveraged is what it is, James. And you can make a lot of money, lose a lot of money very quickly, right? Very, very leveraged. Yeah, James, absolutely. In any arena, you have to have stops. I just want to make that super clear. I'm not saying you don't have stops. I'm saying the way most people use stops, it ends their career because they're not used properly, which all revolves around lack of confidence, which revolves around emotional issues, which revolves around not really having learned charts properly in the first place at the right time. When you learn charts and you have confidence and you get small wins and you build confidence, you learn the charts better. It's this upward cycle that makes you develop as a trader. And when you don't have that, you have the reverse, and the reverse is terrible. The reverse is, it's the downward spiral, right? Here you've been here, right? We've all been there, right? You try to trade, you have a couple winning trades. You take here. I may cut this out of the recording, but I have no hurry to go anywhere, and you guys, some new people are all interested. Here's what happens, right? If you guys have been trading a little bit, goofing around, probably hopefully with smaller amounts of money, here's what you do. You have this concept you have. You're following somebody, you have a strategy, whatever it is, right? You get in a trade. I'm talking to whoever's listening, James, Ricardo, MG. You get in a trade and it stops out. And that's okay. Some trades stop, no big deal. You get in another trade, it's not working well, and you decide to get out at a small loss. Now you got a couple little losses sitting there, right? Then the next trade starts to work, and you're all happy. And you're looking around, you're saying, gee, I think it go all the way to here, but you know what? If I were to sell it now, it would kind of wipe out my first two losses, and I'd be break even. I kind of like that idea. I think I'll do that. Boom, you're out. You're break even. You take another trade. It doesn't go that well. You sell it for a small loss. Does this sound familiar, anybody? It sound like the story of your life? Right? And you just keep doing that. And if that's what you're doing, think about it. You now have a trading concept which says, I'm trying to lose a small amount of money. That's what you're trying to do. Your goal, your ultimate goal would be to break even. That's what you're trading to do, right? You're intentionally trying to make your best trades cover your losses. Well, how do you make money when your goal is to break even? Right, and that's your goal, to break even, right? And then you don't. You end up a little bit under that, and frustration sets in. And the problem is, while you're doing all this, guys, while you're going through this frustrating process, you know what you're not learning at all? What are you not learning? And this is really one of the biggest keys, one of the biggest things that I try and get people around when I teach them. What are you not learning when you're going through that frustrating process? You're not learning or developing on the charts. You're not learning more from the chart because you're in constant fear, right? You're not learning anything from that chart. You're mad at the chart. You're throwing staplers at your screen. You're not learning from the chart. You're just pissed at it because it's not doing what you want it to do. You don't learn a thing. You don't learn from the trade. You go to the next trade. You're just trying to make your money back. That's the downward spiral where you're never going to improve. And you got to get around that, through that, over it. Okay, I'm done. Any questions, anybody? All right, guys. Have a great evening.